You just realized something. That extra $1,000 sitting in your checking account, it's been there for 3 months. And every time you look at it, you feel this weird mix of pride and panic. Pride because you actually saved it, panic because you know it's just sitting there, losing value while inflation chips away at it like rust on metal. You want to invest it. You know you should invest it. But every article you read assumes you already know what ETFs are, what a brokerage account is, what the difference between Roth and traditional means, and you're too embarrassed to ask. So it just sits there, dying slowly. Today, that ends. I'm going to show you exactly what to do with that first $1,000, step by step. No jargon, no assumptions. And make sure you stay until step 4, because that's where most beginners accidentally lock themselves out of thousands in free returns. I'm a financial educator, and this channel exists to translate wealth building into plain language. Because here's what nobody tells you. The reason investing feels complicated isn't because it is complicated. It's because the financial industry profits from your confusion. Confused people pay higher fees. Confused people stay in bad products. Confused people never start. And when you never start, you stay dependent on a paycheck forever. That's not an accident. But you don't need a finance degree to break out. You just need someone to show you the actual buttons to push. So let's push them. Step 1. Open the right account. And I mean today. Not next week, not when you've done more research. Today. Because every day you wait is a day you're losing to inflation and opportunity cost. You need a brokerage account. Think of it like a bank account, but for investments. The difference is your money doesn't just sit there, it works. Now, which brokerage? If you're starting from zero, you want 3 things. No account minimums, no transaction fees, and a clean interface that doesn't make you feel like you're piloting a spaceship. Fidelity, Charles Schwab, and Vanguard all fit this. Pick one, it doesn't matter which. What matters is that you open it in the next 30 minutes. Go to their website, click Open an Account. Choose Individual Brokerage Account, not retirement, not custodial, individual. They'll ask for your social security number, your bank info, and your address. That's it, 10 minutes. And then your account exists. You are now an investor, even if you haven't invested $1 yet. The psychological shift happens the moment the account is real. Now, here's why this matters. Most people spend 6 months researching the perfect brokerage, comparing fee structures they don't understand, reading Reddit threads that contradict each other. And in those 6 months, if they just picked one and started, their money would already be growing. Analysis paralysis costs more than a wrong choice, because the difference between these brokerages is negligible. The difference between starting and not starting is everything. Step 2. Transfer the money. Log into your bank. Set up a transfer to your new brokerage account, $1,000. And here's the psychological trick. The moment you move it, it stops being spending money. It becomes investment capital. Your brain categorizes it differently. It's no longer part of your lifestyle budget. It's part of your future net worth. This mental separation is critical because if it stays in your checking account, it will evaporate. Not into anything dramatic, just into slightly nicer groceries, a spontaneous dinner, an upgrade you didn't need. Death by 1,000 cuts. But once it's in your brokerage account, it has a job, and that job is to multiply. The transfer takes 2 to 3 business days. While you wait, let me tell you what happens to people who skip this step. They keep the money in savings, telling themselves they'll invest it later. Later becomes next month. Next month becomes next year. And 5 years from now, they still have $1,000. Except inflation means it now buys what $700 used to buy. They didn't lose money, they just never made any. And that's the silent killer. Inaction. Step 3. Buy your first index fund. This is where it gets real. You're going to search for a ticker symbol, VTI. VTI. It stands for Vanguard Total Stock Market Index Fund. What is it? It's a single investment that owns tiny pieces of nearly every publicly traded company in America. Apple, Microsoft, Tesla, Nvidia, the corner store that just went public. All of it. Over 3,000 companies. When you buy VTI, you're betting on the entire American economy. And historically, that bet has paid 7 to 10% per year on average. Not every year. Some years it drops, some years it explodes. But zoom out over decades, the line goes up. Here's how you buy it. In your brokerage account, click Trade or Buy. Type VTI. It'll show you the current price per share. Let's say it's $250. You have $1,000. You can buy 4 shares. Some brokerages let you buy fractional shares, meaning you can invest the full $1,000 even if the math doesn't divide evenly. If yours doesn't, just buy as many full shares as you can and let the rest sit in cash for now. Click Buy, Confirm, Done. You are now a shareholder in the American economy. Now, here's what most people think at this moment. They think, that's it? That's investing? And yes, that's it. Because the magic isn't in the complexity, it's in the compounding. That $1,000, left alone for 30 years at 8% annual average growth, becomes over $10,000. You did nothing, you just didn't touch it. And if you add another $1,000 every year, you're looking at over $100,000 in 30 years. This is how ordinary people retire rich, not through genius, through patience and consistency. Most people think you need to pick stocks, find the next Amazon, time the market, and some people try. 90% of them lose money because beating the market isn't about being smart. It's about being luckier than professionals who do this 80 hours a week with algorithms and insider information. You will not outtrade Goldman Sachs from your couch, but you don't need to because VTI gives you the average return of the entire market, and the average return is enough to build wealth. Boring beats brilliant. Step 4. Set it and forget it. And here's the critical mistake people make that I teased at the beginning. They check it every day. They watch the balance, and when the market drops 3% in a week, they panic. They sell, they cut their losses, and they lock in those losses permanently. Then the market recovers, like it always does, and they're on the sidelines, watching their potential gains happen to someone else. The people who win are the ones who buy and then don't look at it for years, because short-term volatility is noise, long-term growth is signal. Your job is to ignore the noise. Here's what that looks like in practice. You check your account maybe once a quarter, not to trade, just to see the number. And over time, you'll notice something. The drop stops scaring you because you've seen it recover before. You start to understand that the market isn't a measure of daily success. It's a vehicle for long-term transfer of wealth from the impatient to the patient, and you are now the patient one. Let me tell you about Sarah. She invested her first $1,000 in 2020 right before the COVID crash. Within a month, her account was down to $750. She freaked out, almost sold, but she didn't. She just stopped checking. By 2021, it was worth $1,800. By 2024, over $2,000. She didn't get lucky, she just didn't panic. That's the whole game. Now, here's what happens next. You start to see money differently. That impulse purchase, you think, if I invest this instead, it'll be worth 3 times as much in 20 years. That subscription you forgot about? That's $20 a month I could be compounding. You're not depriving yourself, you're choosing future freedom over present comfort. And that choice, repeated over years, is what separates people who retire early from people who work until they die. The system wants you to stay a consumer, to finance lifestyles you can't afford, to rent your existence from corporations. But the moment you become an investor, you flip the script. You stop being the product, you become the owner. And ownership is the only path to independence. So here's what you do right now. Open the account, transfer the money, buy VTI. Then close the app and don't look at it for 6 months. Let it do what it's designed to do. Grow, compound, build. You now have a clear plan to turn your first $1,000 into the foundation of real wealth. But here's what happens next that nobody talks about. Once you start investing, you're going to hit a wall. You'll run out of extra cash to invest. You'll realize your income is the ceiling. And that's when you need to learn how to increase your earning power without burning out or selling your soul. That's exactly why I made this video right here, which shows you how to add an extra $1,000 a month to your income using skills you already have. Click that now, and I'll see you there.